Ladies and gentlemen, good afternoon and welcome to this webinar brought to you by the Northwest University. Today we are specifically focusing on economic sciences, and I have two experts here from the School of Economic Sciences at the Northwest University. If at first you are perhaps not as informed as our experts and you were worried about this being a webinar about one of those mattresses that you buy and you have to inflate, and this is a whole debate regarding inflation and deflation when it comes to sleeping, we are going to keep you awake with some ideas on the economic point of departure once we talk about inflation and deflation. Now, we could have spoken about a number of different things, and that's exactly what we do at the Northwest University. There's a whole range of topics and ideas and themes that we engage in, and so can you once you enroll for your postgraduate degree. If you are specifically interested in your master's or your PhD in the School of Economic Sciences, you'll get an idea of more or less the discourse, the kinds of discourses that we engage in the School of Economic Sciences. Right, so let's get into it. What is the economist? What's the nature of an economist? We have to say that such a person is a number of things. A philosopher, of course, knowledgeable about the economy and about the specifics thereof, but we want you to think a little bit deeper. We want you to understand what happens at grassroots level, but we also want you to philosophize about what's going on in the world of the economy. Now, of all the things we could have spoken about, we chose to speak today about inflation and deflation. And I think you'll soon see that there are so many other factors that play into the idea of inflation and deflation. We'll try and cover them all. If not, well, we'll just have to reschedule again and perhaps engage with you once you start talking about that topic for your master's or your PhD. If you are watching this on YouTube, you're more than welcome to make some comments and pose a few questions. We will see those comments come through live, and I'll pose them to the two experts that I have here with me in studio. So please feel free to comment. We'll see your question and we'll try to address it. The two experts I have here in studio with me today are, of course, on my far right, Professor Waldo Kriegel. Waldo, thank you so much for being here this afternoon.
Thank you, Geert.
And to my immediate right, Andre Heymans, Professor. Thank you so much also for availing yourself for this afternoon's discussion.
Thanks so much, Geert.
All right, so let's get at it. We're talking about inflation and deflation. Let's start off, Andre. And for who is this debate? For who would see this as a relevant topic?
Well, basically anyone that's got anything to do with money. So you would be you would be the first one. So no, inflation, the inflation-deflation debate is very important for policymakers, for your normal retail consumers, you and I, investors, savers. Yeah, basically anyone that's got anything to do with money. So if you use money, inflation is your enemy. Looking at inflation, this is basically your purchasing power being eroded over time. So you get the same salary, and that salary will buy you less tomorrow than it will buy you today. And so that's really the fear. And we are definitely we all know about inflation. It's the fear of every consumer, every saver, and that's why this debate has come up again in the wake of what we've seen over the last, let's say, 18 months or so, the unprecedented creation of money because of the COVID pandemic and the world basically coming together trying to combat the adverse effects that it had on global economies.
So, Waldo, is deflation then just a nominal idea, some abstract thing that never happens? Because I can't think of somewhere in my life as a consumer where I felt, my goodness, I have more money.
You technically wouldn't have more money, but you might have a bit more buying power. So I think there's also a distinction to make between the increasing in prices and prices increasing slightly at a slightly lower rate. So the rate of increase is slower. That's still inflation, and then with deflation, it actually there's one excellent example in the world, and it's the case of Japan. Since they experienced their banking sector troubles in the early 1990s, almost all prices in Japan have stayed stable or the same. So there's actually a generation of people who've never experienced a price increase. And to the detriment of their economy. I think Andre would agree that you always need a little bit of inflation. It's also grease in the wheels of the economy. The fact that prices are increasing a little bit makes it viable for an entrepreneur to join a market and say, I'm also going to sell something. If you know that you will never be able to ask a higher price than you are asking now, that's a lot of pressure. But if prices in general are going up, it helps to grease those wheels. Of course, you don't want runaway inflation that really erodes the buying power of your money. That's to the detriment of investment. If you don't know what your money is going to buy, it's difficult to invest in a project that's going to give returns over 5 years or 10 years. So high levels of inflation is a definite bad amongst economists. But you also do need a little bit of it. And so we haven't experienced deflation any time recently, but it does exist and it's out there. And in a way, it's even worse than moderate inflation because it's accompanied by economic stagnation. Yeah.
And case in point, if you look at what happened to Japan, Japan was touted to overtake the US as the largest economy in the world in the mid-80s, from early to mid-80s. And they basically had their crash in 1989, and as Waldo pointed out, in the 90s, they really started going backwards. And so they fell back because economic growth sort of stagnated. And the Bank of Japan started what we now call monetary easing, or I mean, there's various terms for it, but they were the first to experiment with creating lots of extra money or pushing a lot of money into the system to try and revive the economy, and that then eventually they couldn't, and I think we'll get to this later in the debate, but they actually could not convince the public to have inflation happen, and this now sounds very strange. But it's a lot more psychological than people would know. If you expect prices to be lower tomorrow than it is today, then you are not going to spend your money today. You're going to wait for that better price tomorrow. Yeah. If a whole generation starts acting like that and they teach that kind of values to their children, you have now a deflationary trend that is very difficult to break. And so a lot of the monetary stimulus that we're seeing now in the, let's say, the Western world is lessons learned from the Japanese experiment, trying to not fall into that psychological trap that prices will continue to fall into the future, because then people they hold back the money, they just don't spend it. And that is then a lot, as Waldo pointed out, that's to the detriment of investment, because no company will be able to, over the long run, be able to be running profitably if consumers keep on withholding their consumption.
I understand. So that was 80s, 90s, the Japan example. Why are we talking about it now? What's the relevance of this debate now?
Well, I think, first off, there were some inflation numbers released today. So at least we're topical. So the August inflation rates, South African ones, were released today. So 4.9%, slightly up from the July numbers, and slightly above the midpoint of the Reserve Bank's target range. But that's not exactly the reason why we have this talk this afternoon. But coupled to that, tomorrow afternoon, the Reserve Bank Monetary Policy Committee will be making their forecasts of inflation and economic growth. So that's it's in their documentation. It doesn't always reach the media in the same way as their decision on the repo rate. So they'll be deciding on the repo rate. Economists are generally in agreement they'll keep the repo rate unchanged. So if I can at least comfort our viewers, we are not here to make any big pronouncements on inflation or the repo rate. But this story of inflation is all over the world, and if you follow the right people on Twitter, that's all that the discussion is about at the moment, and it's specifically about inflation in the US, following a drop in aggregate demand last year. People were locked up at home, no one was spending, and we saw some deflation. There was a mad time, I think, towards in the end of May last year, when oil futures prices were zero or even negative in the US. So you had to pay to keep oil in storage, which is
It's strange.
It's unusual.
It's really
but since then, economies have recovered, people are spending again, etc. And there's been some upward pressure on prices. And the big question is this transitory? Is it going to disappear again? Or are we seeing sustained inflation, that prices are now going to really keep on increasing in these developed economies? And what implications does that have for a developing economy like South Africa, if it's the case that inflation is back?
Well, I'd like to get back to that, the South African relevance of the theme, because we know now, of course, the USA is a global leader, and what happens there has an impact on us. But what is the South African situation?
Well, Geepie, one cannot actually speak about the South African situation, or any other country's situation for that matter, without speaking about the US, simply because the US is such a big player. And after sort of the fall of Bretton Woods and moving off the gold standard, the dollar has really become and remained a reserve currency in the world. So a lot of South Africa's inflation is imported. And what I mean by that is we import our inflation via spending on things like oil and energy. Now, the implications of that is whatever happens to the dollar is sort of for South Africans, the flip side of that coin is the rand. So dollar strength means weaker rand. A weaker rand means we pay in rand terms more for our energy. Sometimes we're lucky and we see falling oil prices when the rand weakens, and so the effect on things like fuel prices is not that bad. Other times we catch the double whammy and we've got a weakening rand while we see an increase in dollar oil price, Brent crude. And that then translates into higher fuel prices. Now, the moment that you get into fuel prices, that's transport of everything that you and I buy from the shelves. So the moment that you go and buy your milk from the store, that milk had to get there via a truck, because in terms of our transport, we, compared to what we did in the past, we transport a lot less goods and goods on our train network. So a lot comes via trucks, big trucks to warehouses, from warehouses, smaller trucks into cities and towns. And these days, after sort of the postal service deteriorated, and with the move to online shopping, a lot more transport in terms of delivery services of all sorts of couriers. So the moment that you get higher fuel prices, you build in some inflation. So that's just on transport side. Then obviously fuel also plays a role in agricultural produce. So tractors, harvesters, whatever, all run on either directly fuel, so diesel, or Brent crude derivatives. So your fertilizers, your pesticides, all sorts of things actually comes from Brent crude. And South Africa, we've got lots of commodities, but oil is not really one of them. So we do import a lot of our energy, so to speak, and that then, so we import a section of our inflation. So that's just, in terms of the supply side, that's where our inflation comes from. And then with looser monetary policy, you might see some demand pull inflation. If money is more easily available, and as Waldo pointed out, we might see lower interest rates for a while still. That can create some demand pull inflation as people don't have to service their debts at higher interest rates. And that then opens up some more, I'm saying, moving space for people to expand the size of their house, or to maybe buy that second car, or go on that local holiday, seeing as we can't travel overseas yet. So yeah, that's the inflation situation in South Africa. And we'll probably get to this a little bit later in the debate. What we also have to look at is sort of the longer term effects. And this whole inflation deflation debate is technically not a new one, and it's been coming for a while. So yes, we might see a little bit of inflation every now and then. The Western world has been trying their damnedest to get inflation going, and they actively announce that. It's not that it's their best kept secret. They are actually, in their wording, whenever they've got policy meetings, they tout the idea that they're trying to get some inflation. And it's all based on the really negative effects of deflation and what we see in Japan and have been seeing there for 30 years.
It's weird though, isn't it? Because for the general man on the street, you would think of inflation as an evil. Yet now, in a very short space in time, you've explained the value of it. That just, it really hits me, because, you know, inflation is almost touted as this, oh my goodness, we're seeing inflation again, everything gets more expensive. It's weird.
True. I think as long as we see it within the Reserve Bank's target range, that's fine. You don't want to see it above the target range. But at the target range level, you do need a bit of inflation. I want to latch on to Andre's point, but it's more of it's his speciality, so I'm only going to introduce it because it's complicated reasoning behind this. So the other reason why US inflation matters is for the flow of money internationally. Where are investors putting their money? So they could invest in a range of financial instruments. And like he said, with the dollar being the reserve currency globally, it's always a safe haven. Investors trust that the US government is not going to go bankrupt at any stage, where other countries, they might sensibly worry that the government might go bankrupt or be unable to service its debt. Let me put it that way. The US will always be able to service their debt with dollar because they print those dollars. Okay, so that being said, in response to the COVID-19 pandemic, the US Fed have been printing money to buy financial assets from banks or other sort of big investors. So in that way, they take the value paper and they put the cash back into circulation, in sort of a simple explanation, with the idea that there shouldn't be a liquidity shortage. If people need access to credit, they should be able to get credit at a low interest rate to just bridge them over the troubles of this pandemic. But they've been doing this at a massive scale. I'm going to be mistaken in the I think I want to say billions of dollars per week that is added to circulation in the US.
That's massive.
The end result of this is that interest rates have been really low on their financial instruments. So if you're an investor who wants some sort of return for people who are putting their money into a pension fund or a savings scheme, you were not buying US treasuries for the past 18 months. You were buying South African government debt, offering you between 8 and 9% return, which is significant compared to what you would get anywhere else. But if inflation in the US starts to really creep up and seem to be persistent, they will not continue with this expansionary policy of printing more and more money. They'll start tapering that, and interest rates in the US will go up. Then it will become a sensible investment again to put some of your money into US government bonds, which would mean that you would be taking it out of the South African bond market or out of the JSE. So in that sense, in a chain that connects a few links, inflation in the US is going to influence their interest rates, which is going to influence the difference between South African and US rates. which is going to influence the rand, which is going to influence the cost of imports, and that's going to have a big impact on South Africa.
Now, we're talking a lot, we'll get to the long-term planning and ideas and look into the crystal ball with regard to inflation over the long term. But for now, whilst we are on the international topic, which other countries should we also talk about? I mean, the US is a major player, I understand that. But immediately China pops up. I don't know what's happening there. I mean, there's definitely an expansionary approach to the global field, what's happening there. We've seen lately an election in Russia. No surprises there, the results.
I wonder who's going to win that.
So, but I mean, that might have an implication. Perhaps we'll see BRICS coming to the fore again. I don't know. Which other countries?
Yes. The thing with China is China is actually running larger deficits in terms of its growth path than any other emerging market has done ever in the history of the planet. So they are actually also a debt-fueled society. They've got massive debts. They also have a lot of assets, but they also have a lot of debt. So everyone is on this bandwagon. The only reason why, and it's nothing really special about the US as a country. What is special about the US is actually, like Waldo pointed out, is dollars. It is the currency of the United States that is what's driving a lot of these market movements. There's also something else that happened sort of after there's a couple of things. You get the euro dollar and you get the petrodollar. And so after the US, after Nixon back in, what was it, 81?
It was
79, I can't remember. But once he took America off the gold standard, there's a lot of other things that sort of became possible. So it is now possible, and it was possible for the last 30, 40 years, for companies outside of the US to issue debt in US dollars. So you could be ExxonMobil and you could be saying, well, I would like to borrow money for some gas exploration somewhere. And I can put out ExxonMobil bonds in dollar terms. And so that was then termed the euro-dollar market. So even though the US can print its own money, there's also other dollar-denominated debt because of the reserve status of the dollar that then came to the fore. So now in the world, there's lots of other dollar-denominated assets, liabilities. So there's a whole world of dollar-denominated debts that has got almost nothing to do with the US. And so, but because they own the printing press, it's their money after all, they can crank up or crank down the amount of money that they push into the system. And to Waldo's point earlier, it's been estimated at the start of 2021, we'll see how we get to the end of 2021, but by the start of 2021, the US has created about 20% of all the money that they've ever created in the last year. So if you just think about what that means, 20% of all the dollars were created in the last year.
Yeah.
Going back a couple of hundred years
Yeah.
now. So this should give you an idea of the scale of money creation. And so that's why this debate actually is coming to the fore now again. Will this push the world into that inflationary and persisting inflation, into this sort of part of the cycle? Or will the other forces, which we'll get to now, will the other forces be great enough to overcome that inflation? And in actual fact, one can almost make the point that what the Fed is doing and what other countries around the world is doing is trying to stave off the inevitable deflation that's on its way. And as Waldo pointed out, the deflation is really bad. You might think, well, it would be wonderful if prices were lower tomorrow. If I could go to the store and I could buy more tomorrow than I can buy today, that would be great. The problem with that is that becomes a mindset, and then people do not consume anymore. So, which is bad for business. Let's be honest. Job creation and all the rest. So yes. So in order to stave off deflation, the printing presses have been, I always make a joke and say, they've gone into the room, switched the light on, started the printer, switched off the light, closed the door, locked it, walked away. That's what they're busy doing. So that's the status quo at the moment. And as Waldo pointed out, maybe if they see that inflation is here to stay, they might start to taper. And for the uninitiated, that is just to stop printing as much or stop creating as much money. The only problem is that the markets will react badly to it. We had they call it the taper tantrum in 2013, I think, when the markets reacted so badly to the suggestion that the Federal Reserve is going to start printing less money in the future, not stopping, printing less. That's such a bad reaction on the markets that they started printing right. They just continued. They just kept going, and that's from the financial crisis onwards. So any kind of gesture by current or previous Fed chairmen and women gets the market into a frenzy, and it starts reacting because of the large sums of money invested. People try and liquidate whatever they can as quickly as they possibly can, not to be caught unaware. That's why we can speak about lots of other countries, to come back to your point, but it's almost not even relevant because of dollars specifically.
If I can latch onto that here, you might have heard the expression that inflation is when a lot of money is chasing too few goods and services. So you've got all this buying power out there, but production is not really increased. So the end result is prices go up. And I think behind that is the arguments that you hear from guys like Larry Summers, who was a presidential advisor at some time, and a sort of famous Harvard economist, where he's now saying the stimulus is too big. The US has printed too much money, and the deficit of federal government is so big that it has to cause inflation. But no one's quite sure yet. So he's making the argument because during last year's crisis, demand and economies collapsed. So is all this extra money and extra debt that has gone into stimulus packages of different kinds, has that been expansionary? Has it really exceeded the productive capacity of the US economy or any of the others? Or has it only been sort of preventing a complete crash, that it's been just enough to shore up whatever activities there were? And so I think that once you have an idea of these quantities, then you would be able to settle this question. Sorry.
And I think that that's a key challenge to economists. Is then when we talk about inflation, is to also talk about how sustained it is, and because you don't want to rock the boat. If I understand you correctly, there should be a steady, within range inflation happening. Are we there? Is this the future?
Difficult to tell. I wouldn't commit to an answer. And particularly in the US case, I think that's exactly what economists are busy with. They are looking for signs, for indicators of whether this is persistent or just transient for the moment. So there are loads of indicators, and freight rates, for example, have increased significantly. So you could say, well, that's a temporary supply chain problem. Those empty containers that are stranded in Vietnamese ports where they are still struggling with COVID, they'll rejoin the system sooner or later, and they'll also be available for the Shanghai-Los Angeles route, and those prices will come down again. Then you read about restaurant owners washing the dishes because they simply can't find people to do it at improved wages. So could that be a sign that maybe the labor market there is getting tighter? And the moment that sort of prices go up in the supply chain story and wages start to go up to compensate for that, then you're getting closer to an inflation cycle where the one feeds the other. But those are are just sort of glimmers of data, and no one knows exactly which way it's going to go. And even with last week's announcement of the US inflation rate, right up until the announcement, there were two definite camps on economics Twitter talking about whether it's going to go up or stay the same or fall a little bit. So it's difficult to know how big the stimulus, or let's say how big the influence of the stimulus has been. We know that there's a lot of new money in the system, but a lot of that new money has gone into tech stocks. People are buying Bitcoin. They're not buying groceries or going on holiday. And that, again, just removes that money from the circular flow. So whether it's, in fact, going to fuel inflation is I think, a big question. Sorry.
No, that's actually, it's very important what Waldo mentioned now, is where is the inflation going? So where is the money going? So if you follow the money, you'll see that because of the very loose monetary policy and the soon-to-be-seen fiscal stimulus from government side, a lot of that money is caught up in the financial system, and it never really trickles down to Joe Bloggs that's got to go and buy milk and bread. And so it gets caught up in big corporates issuing their own debt and gobbling up some of that money. It is like I said, caught up in government bonds, in tech stocks, in all sorts of exotic investments, without it really reaching Joe Public. The first time that it reached Joe Public was stimulus checks, where the government in the US physically give people money to then invest. But now a section of that money also ends up in the stock market, because that's the way you get rich, right?
Yeah.
So if you're already not just surviving, you take that money and you invest it. It's being pumped back into the financial system. And so this has led then to lots of debates about, are we in a stock market boom or bubble? Is current stock market prices reflecting true value of the companies? Can they really show us the revenues? Does that match up with the stock prices? If you look at things like PE ratios. So a lot of that money is not really going to what we would think of as everyday items. And therefore, there's a debate on whether there's really inflation, or whether the stimulus really manages to get inflation going. And or stave off deflation as we see it.
You're touching on something that I want to get to now, and that's the general public in South Africa. You know, how this inflation thing touches on our lives. We hear from government that there's a desire to invest in infrastructure. I think it's one of the key priorities in South Africa. It's been defined. What's the effect of that on inflation in South Africa, and is it a good or bad thing? And secondly, it comes back to your world where you have to know something about everything, and that's policy. How can economic policy, where does it sit? Is it Minister of Finance? Is it trade or industry? Who influences policy that would actually address what we're speaking about now? So first, let's talk about infrastructure investment.
I'm going to jump even a step before infrastructure investment. to say that I can well understand that anyone listening to this would think, what are these guys talking about? Inflation in South Africa is absolutely under control. The Reserve Bank's been doing an excellent job. So they are celebrating their centennial. It's like 100 years since the Reserve Bank was established, 60 years for the Rand, and 21 years for the inflation targeting framework, which is just 21 years of the bank targeting inflation and setting policy in a very transparent way and managing inflation expectations excellently. So
So Waldo, are you giving us good news?
Yes. So let me put it this way. So in that sense, that part of policy making is very healthy and working well. To the extent that the governor recently said he thinks the inflation target should be a bit lower. He's even willing to try and manage it down even further. That's a different debate. But at least in that sense, inflation in South Africa is under control and well managed, even I think in terms of wage expectations for the next year or two. No one's expecting inflation to run away and demanding very high wage increases, and even the settlements have been very realistic. True, the governor also said his main problem are the administered prices. Prices set by government and other sort of public entities that are typically higher than the average inflation rate. But that's another debate that we'll get into. So point being, things that can cause inflation in South Africa are these external effects to a large extent. So what we're doing domestically is unlikely to fuel runaway inflation anytime soon. For that, the whole economy needs to do better. People need to go out and spend like mad. All the money that was saved up last year by not going on holiday, you just need to splurge it away. And then jobs need to be created, and the labor market needs to get tighter, and inputs need to get scarce, and costs need to increase, and then you'll start seeing some real inflation. So even the infrastructure, that kind of spending is unlikely to fuel inflation. The money for that already exists, and we've seen some big private sector players saying they're available to enter into infrastructure development projects, but the way that partnership with governments is supposed to work, that's not quite clear yet. And unfortunately, government doesn't have the money. They need to leverage private money for all of their plans. And I think the day before yesterday, there was a confidence index out on the building industry, but specifically the civil side, the big works. And their confidence is even lower than the previous 4-year low, mainly because those big players see no new orders on their books and very little from the public sector. So there's a lot of talk about we will be rolling out more housing, we'll be investing in the ports, in the railways, etc. But that money is not reached the ground yet. So it's also not going to fuel inflation yet. Unfortunately, I must say that money is not really, or those projects have not kicked off on any significant scale.
To Waldo's point, if you look at local inflation or inflation anyway, it is also, I'm going to sound like the quintessential economist now, but it's always a demand-supply thing. And with not a lot of projects coming out, with people not really having money to splurge, there's more than enough things, goods and services that we can buy. So in other words, there's not too few goods and services that too much money will chase. And therefore, we're not seeing that inflation. It is only when you've got a booming economy, things are, you have to buy this now, otherwise in 5 seconds it's no longer there. That's when you start seeing the inflation. And because of big infrastructure projects not really rolling out like being promised or what we expect to see, it's not coming through that avenue. And so that's why I agree with Waldo there. I think inflation for the foreseeable future really quite under control, depending on what happens externally.
Yeah.
I want to add on to that. Maybe some viewers are thinking, have you seen the food price inflation rates? We have. Yeah. So I can't completely explain why food price inflation is that much higher than it's been for a while, and it's persistently high. If you read up on what agricultural economists are saying, they're saying even in spite of a good season this year, grain prices have been high, and linked to that, different kinds of meats, etc. But it has to do with agricultural conditions in South America and in North America as well. It has to do with Chinese buying power, buying produce in Brazil that gets reflected in our prices as well. So those sorts of forces behind food price inflation And even then, with again another good season for South Africa, so 21-22 summer season looks like it's going to be a good harvest again. So which would probably help to taper that food price inflation. At least it's going to increase slower than it's been increasing at. But no one's seeing those prices falling anytime soon. Maybe there was some speculation as well that when you couldn't go on holiday, you just barbecued every second evening, and that's been keeping prices high. So that could be part of it, that there's a demand side to the story too. But yes, we know that food price inflation is at the moment the one that stands out from the rest.
Look, and it's also because we no longer operate in silos anymore. There's global trade is with us, and it's here to stay. A lot of our produce are also exported, and once you start exporting, or once it's possible for agriculture for agricultural producers or the producers of agricultural products to start exporting, they then have to make the decision and say, well, if I'm going to be exporting, I'm going to, let's say, get 100 Rand per kilogram for my product, versus the local market that will pay me 80 Rand a kilo. So my choice is quite clear. I'm going to export. If there's anything left, or if for the local market to then compete with the external buyer, or the buyer from a foreign buyer, they will also have to offer that 100 Rand to get the product. And so a lot of that is then reflected. So it's actually it's global demand and supply that has an influence on local prices. Because we can easily ship that produce somewhere else. And then, as Waldo mentioned, it's all about how much money or how wealthy foreigners become when you compare them to South Africans. And then because that will then drive that price differences, and whether you would perceive that as now getting out of hand, or prices increasing more than you can afford to pay for them.
Once we start talking about the Masters and PhD, you have to remind me to ask you about methodology, because I'm seeing a crazy plethora of data and correlations and factor analysis and so on. I think you can go crazy. So the fact that you two are still sane is a credit to your own intellect.
That's an assumption.
All right, I want to talk about two other things that might influence this, and it's budget deficit. What's the role of budget deficit on inflation, deflation? And then our status. I mean, we are still in junk status, aren't we? So I'm worried about that. I mean, what's the impact of the prolonged staying as a junk status country on our inflation and deflation? So let's first start with budget deficit.
Okay, budget deficit is not that big of a problem yet, but it's heading into really bad territory. Because of the rebalancing of our inflation basket, the basket of goods and services that Stats SA makes use of to determine what inflation really is. The recalibration of the basket showed us that we actually have a lot more value in our economy than we thought we had. So our debt to GDP is under 80% again, which is sort of a key mark, which is a lot better than the US currently at a 130, 140 percent of GDP, or Japan at 200 and something percent of GDP. So debt to GDP, we're not doing too badly. What is a problem though is our high interest rates. So I personally would rather owe $1 million at 0% interest than owing $1 at 100% interest. So because that then easily runs away with you. So yes, it is a concern. It's reflected in our in Moody's and Fitch and S&P downgrading us because that reflects their view on the likelihood or the probability that we might at some point default on our debt. So yes, it is a concern.
Adding on to that, the Fitch yesterday said that they're still keeping an eye on the new Minister of Finance to see whether he can continue with the consolidation plans to manage that budget deficit as a percentage of GDP down, to manage the public debt down. And he's been lucky with the boom in commodities prices. Government's been getting a lot of tax revenue from the mining industry. So some of that money's already been spent on some of the COVID relief and in response to the unrest in KwaZulu-Natal and parts of Gauteng. So some of that's been allocated, but he has more breathing room than he thought in February in the run-up to his mini budget in October. But now that there are also other demands for money, so you have people making sensible arguments to extend some sort of income grant, and not maybe the universal basic income grant, but to extend grants a bit further. There are others saying, well, we should use this bit of extra money that we have and kick off the NHI. And there are loads of proposals. The moment there's a bit of extra money on the table, people think up ideas of how to spend it. It's the minister's job to say, no, we're going to use this to repay the debt or to borrow less. But the borrowing that is taking place is mainly in the domestic bond market. So it's South African pension funds buying government debt. And that can continue sensibly. But once the perception is out there that it's becoming unsustainable, those interest rates go up, and then the interest that has to be repaid in next year's budget just grows in size up to a point where you're only paying interest and salaries, and there's not money left for anything else. So that's the dangers of the fiscal cliff or a debt trap, or those sorts of terms that economists use.
Such a fine balancing act, isn't it? It's always, you have to be just there. You can't afford to deviate too much, because then there's an overreaction which is based on sentiment. It's not based on logic, or there is you've just gone too far. You've expanded beyond the limits of logic. Now, if we've been talking about the immediate future now and the immediate situation, 1 or 2 years, that lay ahead and so on. What about long term? If I'm thinking about our kids, and we want to put things in place that would address inflation, deflation in South Africa, what is within the South African context, within our power to do something about this? Do something positive.
GP, what we actually have to talk about, I like your question, but I would like to answer a different question.
Why do you have kids?
No. So the question really should be, what is happening currently? Because we can say, well, we need to address something, but what is that something? What is that animal that needs to be addressed? And so the elephant in the room is, and that's not you, the elephant in the room is the movement, or actually what started in Japan as a precursor for the rest of the world. And so if you look at what happened in Japan, and this is now circling back to the whole inflation, deflation debate, and that's why there's a debate in the first place. So regardless of all the money printing we're seeing, and regardless of all the fiscal expansion and the monetary expansion that's still promised, that still needs to be rolled out, I think in the US they're currently voting on bills of, I think, $3.5 trillion to be rolled out in fiscal stimulus. So besides all that, there's been a steady movement towards deflation for two very prominent reasons. And we saw both of them play out in Japan, and that's why they were front runners by such margins in the world. After the Second World War, Japan they were decimated. And they had a systematic plan to get out of that poverty trap that they were trapped in. And that made them global leaders in technology. And so by the time that and you can even see this in popular culture, if you go and look at movies from the 1980s, you will see that even Hollywood started recognizing the Japanese in all sorts of ways. They were touted as the technology leaders. If any kind of electronics were made anywhere important, it was made in Japan. And so they hit that that sweet spot between a stabilizing, well, they grew themselves out of poverty, and the moment that any nation grow themselves out of poverty, a couple of things happen. You get increased living standards and a drop in population growth. So the drop in population growth that is one of the main drivers that will drive deflation going forward as well. So that's one. And the second one is they concentrated on technology. And now both a decline in population growth, or then even a decline in population like we see in Japan now, not only in the growth of people, but just in total. So if you go and look at that demographics and you go and look at technology, both of those are drivers of deflation, for the very simple reason that we are able to today communicate to anyone in the world. Whereas 50 years ago, you had to either make a long-distance call, which was very expensive, or you had to get on a ship and go there. Take you 2 weeks or 3 weeks, depending on where it is. And so the cost of doing business was a lot more expensive. It just became, in a very short space of time, a lot cheaper to do anything. So technology really drives down prices, which is deflationary. We've seen since the Industrial Revolution, we've seen a number of other revolutions, and this is also a debate, and I mean, you'll see this at every Davos speech every year. So whenever you see the World Economic Forum talking, the fourth Industrial Revolution will feature. And it's a very significant debate for this very reason. The fourth industrial revolution is basically a combination of lots of different technologies making life easier and also making life cheaper, because everything is just more efficient. So we've seen over time a culmination of different technologies, and now we're at the point where we no longer see linear trends but exponential trends in how efficient things become, because we no longer have technologies that operate in their own silos. You have communication that improves production, that improves the next thing. So now you get technologies working together to make everything more efficient. So that is a major driver, and it's here to stay. Unless we are willing to go back to the Stone Age, we are going to see an exponential growth in technology, which will lead to an exponential pressure on prices because of efficiency.
Yeah.
And so if you look at the debate at the World Economic Forum, it's all about robots replacing people, which is also deflationary. And for two reasons. One, you no longer have people who get money, who can spend that money, so that's deflationary. And two, that machine or algorithm or what it might be is just more effective and more efficient than the human. So that's the one main driver of deflation going forward, and that's what all the money printing is really about. And the second one is demographics. As we lifted millions and millions, you can actually reason that we lifted more than 1 billion people out of poverty in the last 50 years. We've got less people below the poverty line now than we ever had as a percentage of global population in the history of people. So that means that by lifting people out of poverty, we've seen the reduction in population growth. And so that's why we are seeing a tapering in projections for population growth. To think I think it's going to hit, there's a debate about that, between 9 and 11 billion by whenever, the year 2100 or whatever the case might be. So we saw a doubling of the human population in the last 50 years. We've seen it double twice. And so in other words, where you had an exponential growth in human population, it's now also exponentially tapering down, which brings less consumers proportionally. That's the one side of population. The other side of population is we also see an aging population. The average American is currently 38 years old. The average Chinese person is about 40 years old. And so people consume different things, and they consume at different rates at different stages of their life. So you hit your main consumption in your 40s to 50s. By your 60s, you live probably in a small house and you lived at before. You drive less cars, you have less children at school, university, etc. So your expenses go down, which is actually a stimulus for the economy. And so all of that less spending, as you see an aging population worldwide, is another deflationary force. So over the long term, and so that's why I say this is actually the answer, or this is the question that we should be asking. What are the forces currently out there? So the forces are demographics, in terms of population growth and the aging population worldwide, and then the second one, technology. So those two are massive forces, forcing prices down across the globe. And I mean, you can see it in pockets. You can see it, for example, when you buy a phone or a laptop or whatever the case might be. I mean, your phone now, or data.
Yeah.
So your phone now can do 1,000 times more than your computer could do 10 years ago.
Of course, yes.
It's
why we're sending tourists to space.
Exactly,
Yeah.
because we can.
You can.
So that is really, so that's the underlying sleeping giant that's actually driving prices down in the future. And so what we see now is an attempt from global or from central banks across the world, and then we'll see this from government soon as we start with fiscal packages. We see that as the counter to the inevitable deflation. And now the question is whether the counter has been too quick, so was it too much too soon? Or in other words, are we going to see inflation in the short term to medium term? Or are they going to lose? Is that inflation going to be transient, and is it going to be just a blip on the screen as prices continue to filter down over time?
Gentlemen, we have to wrap up. Let's get back to my question as to understanding your world. How in the world do you go about improving hypotheses or exploring an idea and proving there to be correlations between when this happens, then this? Because it feels to me as if you have so many permutations in your world. How do you go about in studying on a postgraduate level? Waldo, let me start with you.
So, Geepie, I would discourage any postgraduate student of mine on tackling the complete question.
Yeah.
It's much easier to tackle a component of it. So that would be my recommendation first off, is to say, let's zoom in on some aspect of this bigger issue and find something sensible to work on. So currently I have a master's student who's looking at this idea of have software, industrial robots, and in artificial intelligence algorithms been replacing workers in South Africa? Can you see that impact in employment at an occupation level and in wages? So that's much more focused. There are data available that you can do this with. You can estimate a regression model and say we've got employment on the left-hand side and it is a function of, and it gets explained by a number of independent variables, and we get a statistical answer from that. And of course, if you're interested in these sort of big macro issues like inflation, there are models for that as well. So we don't go too far from the data. I think, at least in our school, we're very empirically minded. So you will struggle to only philosophize about these things. At some stage, you have to try and pin it down with available data and systemize your thinking in a way that reduces all these moving components into a few big ones that you can track and try to predict.
I love the structure. It gives a bit of safety to a postgraduate student to know that you're not going to be left alone. There is structure, there is sound methodology, sound methoding when it comes to approaching some other problem. Gentlemen, thank you so much. You live in a fascinating world, and I think over the long weekend coming, you are going to get a lot of invitations to parties and braais and so on, because it must be fascinating to have an entire evening to sit and talk with you. Thank you so much for your time, Andre and Waldo. Really appreciate it.
Thanks, Geepie. Yeah, it was nice being here.
Thank you. Now, ladies and gentlemen, if you are interested in this and more, do contact us. Visit the university's website, www.nwu.ac.za. and go to Economics and Management Science. Go look for the School of Economic Sciences, and you'll find these experts and more. We look forward to your postgraduate application.